What's lurking in your expense reports? If you've ever wondered why your company demands receipts for even the smallest expenses or how these policies evolve, you're not alone. In fact, many business professionals are asking the same question. Here's the twist. While the IRS raised its receipt threshold decades ago, most companies went in the opposite direction, tightening their requirement. Why? The answer lies in the numbers and some surprising patterns revealed by data analytics. Imagine this: an unusually high percentage of expenses claimed just under the $25 limit. Coincidence? Not likely. It's a fascinating example of how behavioral trends exposed through data analytics are shaping financial and expense reporting policies today. In this talk, we'll uncover the surprising story behind the stricter receipt policies, and when did $25 become $5? 2, how data analytics can catch hidden inefficiencies and save your company money. And 3, the ripple effects on purchase orders, credit card limits, invoice approvals, and more. If you've ever struggled with fraudulent expense claims or policy abuse, policy enforcements, or finding time to review every receipt, this talk is for you. Stay with us as we dive into the numbers, explore the psychology behind the policy changes, and reveal practical strategies you can use today. The issue: if we went back not too long ago, say 10 years ago, you would find that most organizations had a receipt requirement of $25. What we mean by this is that if someone wanted to be reimbursed for an expense or put an expenditure on their company card during the course of business travel, they just had to provide a receipt for everything over $25. Under that, the threshold was willing to take the employee's word that that was the amount they had spent. The reason the companies had to get the receipts, aside from their own monitoring requirements, is that the IRS requires the organization to be able to produce these receipts if the organization wishes to deduct these expenses from its income for income tax reporting purposes. And of course, most companies definitely want to do this. What happened next? But a funny thing happened on the way to the tax reporting office, if you will. In 1995, which was 30 years before 2025, I just want to point out, in case you're not counting, the IRS raised that $25 limit to $75. Now, many, dare I say most, companies are very good about mirroring the IRS requirements in their own policies. You don't have to do it, but most do. But this was one that they did not adopt. What's more, they did the opposite of what the IRS did. Now, if you're thinking that's odd and there must be something going on here, you're right. What companies did. Today, only about 8% have followed the IRS rule and raised their receipt requirements to $75. This comes, by the way, this 8% number from a survey done by AP Now of its readers and members who are involved in this area. Many of the others, and I should probably say most of the others, have lowered their receipt requirement, some going as far as to require receipts for everything. Additionally, today, over 50% of all organizations now also require the detailed meal receipt if a meal is involved. But we'll get to that in a little bit. First, I want to talk about why they lowered the receipt requirement. Do you think they did this because they want to give their employees a hard time, or were looking to create more work for their staff reviewing expense reports? I don't think so. Let's take a look at what happened. It's another example of data in action. Let's look at the analytics behind this move. Organizations that analyze the data from their employees' expense reports found an inordinate number of expense reimbursement requests just under the $25 level. This wasn't just one or two companies. It was basically every organization that looked at the data. As those familiar with statistics can attest, Benford's law can be used to predict the percentage of receipts that should have fallen into this category. And the numbers being found were not a little higher, they were much higher. And if they did a deep dive into the numbers, just looking at reimbursement requests between $20 and $30, you know what they found? You're right, an amazingly high percentage of them were just under $25. So what was going on? It didn't take employees long to figure out that they only had to turn in the receipts for over $25. And if they'd gone out, and let's say they'd gotten a Big Mac fries and a Coke at McDonald's for dinner because they were on a business trip and they were tired, and they just got that and brought it back to their room rather than sitting down in a restaurant. They figured out that they could make a few bucks by claiming they'd paid cash for a meal, say $24.95, instead of the average $9 that it costs on average for that meal. They do even better, by the way, if they just had a slice of pizza and a soda, but that's another story. But since no receipts were required for expenditures under $25, this could not be proven. So they'd have their $9 meal, but when they did their expense reports, they'd put in $24.95, $24.50, and they make $15 on the side, give or take. The simple solution. It didn't take companies long to figure out that they needed to lower the receipt requirement, which, as you can see from the data, companies did in droves. And in their efforts to weed out all sorts of game playing with expense reports, over 50% now also require the detailed meal receipt. Those who are responsible for monitoring their organization's expense reimbursement requests should keep in mind that just because you are collecting all these receipts doesn't mean you have to check and verify every single one of them. You can and should spot check. Before we get into the implications of this type of analysis on other aspects and other facets of your business, I want to address the issue many may be wondering about. What earthly good can come from checking a detailed meal receipt? Let's talk about them for a minute. The detailed meal receipt. Initially, detailed meal receipts were collected mainly by organizations that did not reimburse for liquor. Many organizations that received grants had restrictions against not reimbursing for liquor in those grants, and they needed to be able to prove that the grant money had not been used for liquor. Hence, they started requesting the detailed meal receipt. You think the IRS requirements for monitoring are stringent? You haven't seen anything until you see the monitoring requirements required by some of these grants. But I digress. When a few organizations started getting the detailed meal receipts and discovered that a few of their employees were buying gift cards, bringing significant others to business meals, and other infractions, the detailed meal receipt became more commonplace. I believe within a few years it will be the norm. I've hinted a few times that there were other ramifications for other parts of your business with this type of analysis, and now let's talk about it a bit. What are these other ramifications? As many of you can probably guess, anytime there's a limit after which there will be increased scrutiny, people will find ways to come in just under that limit. At one private company where I used to work, the chief operating officer looked at every single expense report. When it was decided, after much debate, that he'd only look at those over $1,000, the number of expense reports suddenly almost doubled overnight. What happened? He was a real stickler when he looked at expense reports, and nothing got by him, and nobody wanted to go in and answer to him about why they had put such and such that really shouldn't have been on there on it. People quickly realized that if they submitted 2 or sometimes even 3 expense reports instead of 1, they would be under the $1,000 limit and could avoid having to explain anything to him. That, by the way, was not the outcome we were looking for, and so to counteract that stupidity, we had to enforce the rule of only 1 expense report per employee per month. The most common place you're likely to see an unlikely surge is just under the approval levels, be it for purchase orders, invoices that were submitted for payment, or anything else that might be broken into parts. You'll also see it on credit card expenditures. What folks will do is split an order or a payment into 2 or more pieces so they don't have to get that additional approval or be subject to that additional scrutiny. As you can probably tell, in order to find these anomalies, you need to do a certain amount of analytical work, although occasionally they'll just jump right out at you. This is just one area where data analytics comes in handy if you work and manage or have responsibility for any accounting or accounts payable function. That's why we put a short talk, a kind of introduction to data analytics, if you will, which you can watch right now using the link that has appeared on your YouTube screen and is in the description. Good luck.